In our last class, we finished turnover and margin. We want to do one last summary on turnover and margin for Walmart. Then we'll move to return on equity, looking at the class notes and doing something called return on equity or ROE decomposition. Then we'll look at what I did for Walmart. And then hopefully we'll get pretty far into relative value analysis, which is the last thing you have for project one. So by that point, we've covered all the important components of a really good, thorough financial analysis. So with Walmart, we finished up talking about their margins. We looked at their turnover. So to summarize the growth part, the turnover and margin, you simply multiply the two together. You can see in chart 14, that Walmart is right in line with the industries. So asset turnover times net margin. So essentially, it's a little bit like return on assets. Return on equity, we're going to talk about it a little bit, but it's essentially the return before we bring in the concept of financial leverage. So it's that term, but asset turnover times net margin. You can see Walmart is right in line with the industry. You see Costco, remember Costco had tremendously great turnover, but very, very low margins. When you combine the two together, they're right in line with the industry and with Walmart. So both Walmart and Costco are right in line. They're consistently right in line with the median of the industry. Walmart's trying to get its online presence with Jetcom and then trying to get overseas with Flipkart. But growth is just not an issue. And this is why I think this is probably one of the most important charts. Asset turnover and net margin are the two most important components of growth in a company. And if a firm is just flatlining, you can see the industry is trending down. It used to be, say, 15%, and now they're trending down to below 10%. It's just a tough industry to produce growth, and it's just not, profitability is not coming easy for this industry. It would be interesting to remember 2020, the year 2020 for Walmart is really February of 2020. So it doesn't have any of the pandemic or the lockdown. So it'll be interesting to see this industry again. If we run the numbers, say March and April, and bring in the entire year of 2020 to see how 2020 impacted this industry. My guess is that the bottom 10% is going to look pretty bad, with some retailers just really struggling. The top might look really good. Some retailers doing extremely well, like a Costco and Walmart. So one last way to summarize it, and your key here is to go back and see where did they do well, where did they do poorly. You essentially want to summarize very quickly. You don't repeat exactly what you said, but summarize your overall summary on turnover, overall summary on margins. So maybe your firm, like Costco, very strong on turnover, very weak on margins, and the net puts them right in line with the industry. What's the trend? So this is a really good summary chart before we get into the last section, which is return on equity. So now we'll move over to the return on equity, the class notes. So return on equity, we're really focused on the profitability of the firm. We're going to combine turnover, margin, and solvency. You notice liquidity is missing, but remember, firms that improve their turnover, like inventory turnover, receivables turnover, asset turnover, firms that improve the turnover are almost always getting more liquid. So it's kind of implied, liquidity is kind of indirectly there. But there just aren't good ratios to put into this particular format. So return on equity is the return of the firm. Think of return as the net income of the firm to the owners of the firm. So it's net income after you paid your interest expense and everything else. That's that net income divided by owner's equity, shareholders' equity, book value, net worth. We have all those different terms for equity. Equity can be, it's just the ownership part of the firm. Equity, owner's equity, shareholders' net worth, book value, net worth, all of those mean the same thing. So we're going to look at how much net income did you make relative to what the investors, the owners, have invested. So return on equity is a measure of return provided to those who own the firm. There are other stakeholders, lenders, employees, management. They have an interest in the firm and in their profitability, but ultimately it's the owners, the stockholders who have 100% dibs or ownership of that net income. Others, like employees, lenders, they want the firm to be profitable so they stay in business and keep paying them. But ultimately, all this net income belongs to the owners. So you would think, well, a firm with high ROE, high return on equity, must be doing well. But the problem is, return on equity includes a lot of stuff. It's a combination of stuff. Some of the things in return on equity are really, really good. Like asset turnover and margin, that's part of return on equity. That higher is better, so if that's driving ROE up, that's good. Some things are bad though. The financial leverage. When a firm uses a lot of debt, it can increase return on equity significantly, but not for a good reason. Your return on equity is up only because the firm has become much more risky. And the financial leverage impact includes two pieces. The interest impact, which hurts your return on equity, and the actual financial leverage, which improves return on equity. So this is return on equity. Return on equity is your asset turnover times your margin. Remember, that's what we just did at the end of the growth discussion. The tax impact, that's the percentage of net income that the firm keeps after they pay their taxes. So the tax impact, just put it in your notes. If a firm pays, say, a 30% tax rate, then the tax impact should be 0.7. If they paid no taxes at all, and there are companies that pay no taxes at all, you should go on the Yahoo Finance and look at Carnival Cruise Line, especially a few years ago. This year it's probably all negative numbers, but a few years ago, their net income before tax and after tax is almost the exact same number. They pay almost nothing in tax. So their tax impact is close to 1. But firms, most firms are paying the tax rate in the U.S. used to be 35%. So for most firms, this number was 0.65. Now that the 2017 tax law changed, you might be seeing this number approaching 0.8 because the tax rate for corporations has been dropped quite significantly. And then the last part is the financial leverage. So I have these parts scratched out. Let me unscratch them out. And let's look at it. Asset turnover, we've already seen that ratio. It's sales divided by assets. Margin, what is margin? Well, there's a few ways we can do margin, but remember one of the margins is EBIT margin. So that's the one I'm using here. We're using EBIT margin. Remember, operating margin is usually EBITDA to sales, but we're using EBIT margin in this ratio. So earnings before interest, earnings before taxes divided by sales, that's our margin. That's our net margin. The tax impact is pretty straightforward. It's net income after you pay taxes divided by net income before you pay taxes. So if your tax rate is 35%, your earnings before tax is 100. You pay 35% in taxes, so you have 100 minus $35. So you made 65 after tax. So 65 divided by 100 gives you a tax impact of 0.65. So essentially the tax impact should approximate 1 minus your tax rate. And then we get into financial leverage. Well, the interest part of financial leverage is your earnings after you pay interest expense but before you pay taxes to your earnings before you pay interest expense and taxes. You notice on the tax impact, the only difference in the numerator and the denominator is taxes. On this ratio, the only difference between the numerator and the denominator is how much you pay in interest. So if a firm had 0 debt, this should be 1. The interest expense shouldn't hurt you at all. But as they start paying more and more in interest, this ratio will drop below 1. It will bring ROE down. However, you have the leveraging impact, which is instead of the stockholders investing their own money, they're borrowing money and investing other people's money. That's going to increase their return on equity. We measure that as assets divided by net worth. That's a measure. There's several measures of financial leverage. The couple we talked about earlier in the semester, we talked about debt to equity. Debt to equity is a type of financial leverage. The ratio we use was debt to EBITDA. That's a measure. So here the measure we're using is assets to net worth. So there's several different ones. You'll see why we had to use this one in this case. And let's just look at it. So let's look at if things will cancel out. So here we had sales divided by sales. So that just simplifies the 1. Here we're dividing by assets. Here assets is in the numerator, so those two cancel out. Here we have earnings before taxes. Here we have earnings before taxes, so those two cancel each other out. Here we have EBITDA in the numerator EBIT in the numerator, EBIT in the denominator. Those two cancel out. And when you do all of that, what do you have left? Net income divided by net worth, exactly the ratio we showed up here. Net income divided by net worth. Now, some students look at that and say, well, why in the world are we doing all of that? It just simplifies. Well, the reason we're doing this, we're trying to break return on equity into its components. Is return on equity high because the firm's improving asset turnover? Is it high because they're improving margin? Those are the good reasons. That's why I say ATO and margin, that's management true added value. Is the ROE going up because the tax rate changed? Well, that's good. If Congress reduces taxes on corporations, that's good for the corporation. But that's nothing management did. They don't control that. And if they're not paying tax because they're cheating on their taxes, then they're all going to go to jail, and that's not what the stockholders want them to do. So we usually don't want to find a firm that's doing great because they don't pay any tax. Now, Carnival Cruise and some of these other cruise lines that figure out a way not to pay any tax, and there's been some debate about firms like Apple and others taking advantage of these transfer payments. The accountants are being creative and finding ways to reduce taxable income in high tax countries and increasing taxable income in low tax countries. So there are firms that manipulate this, but that's probably not the number one reason you're investing in a firm. And then you get to these, if the ROE is going up because the financial impact is high, that is, the amount of debt they use more than offsets the cost of that debt, the interest expense, which for most firms that's true, then ROE is high just because the firm took on a lot of debt. That we don't want to congratulate management for that. Yeah, their return on equity is higher, but they're also much riskier, so they need a higher return on equity. In order to satisfy the stockholders, remember, the return you make needs to cover the investors for their risk. If the firm's taking more risk, they need a higher return on equity. So this is not adding value to the firm, it's just adding risk. So the true value added are these first two. One thing to say, when does financial leverage help increase ROE? Anytime return on assets is greater than the cost of debt. So remember I said asset turnover times margin approximates the net income divided by assets. When that is greater than the interest impact, the cost of debt, how much they're paying on debt, then using more debt will increase ROE, even though it doesn't mean the firm's more profitable. It just means they're riskier. So it's a pretty simple firm. This is true for most firms. For most firms, using more debt will increase the return on equity, but we do not want to give management credit for doing that. All right, so that's the return on equity side. So how do we want to handle this? And so let me show you a way you can handle it with the Excel spreadsheet first. So here's the Excel spreadsheet. I'm going to add a whole new page right here. And let me show you that really understand this. Think about the pieces. So we have asset. Well, let's start with return on equity. Let's bring that over for Wal-Mart. Return on equity is pretty far down. It's one of the last charts. Here's their return on equity. I'm going to bring it over looking at the industry. Return on equity, copy and paste that right here. Let's modify it a little bit so we can see it a little bit better. So I'm going to select the data and let's see what we can do here. Let's take the 90th and 10th percentile. We'll leave Costco in there. And let's change our ranges here just so we can see it a little bit better. Let's start at 10%. So we look at return on equity for Wal-Mart, and boy, it's been declining, and then it did something unusual in 2019. No telling what that is, but generally the result has been it's coming down, where the return on equity for Costco has been improving. Walmart used to be well ahead of the industry. Now they're right on top of the industry, and Costco is much higher. So now the question is, why is Costco's ROE going up and Walmart's going down? So let's look at the components. So we have asset turnover. So you go back to print page 2 and you go find asset turnover. Here's asset turnover. I'm going to bring that over. And again, I'll just leave. So here we can see on asset turnover, one of the reasons Costco is so much better than Walmart is they have really strong asset turnover. However, you notice Costco's return on equity is going up, but their asset turnover is flat. So you can't say their ROE is going up because of their strong asset turnover, because asset turnover hasn't been going up. So that doesn't really answer the question. Let's look at the net margin. So we go get the net margin. I'm going to put it over here. So asset turnover is pretty flat. Let's look at net margin. We know in net margin that Walmart does better than Costco. Costco is very, very, very flat. Walmart's doing better, but it's getting weaker. So one thing we can definitely see is asset turnover has been flat, has recently come down. Margin's been coming down. So one of the reasons this is coming down is the net margin. So that's one of the most important reasons for Walmart. We still don't have an explanation of why Costco is going up so much. All right, what was the next piece? Well, the tax impact. Let's see if there's anything going on there. So I'll go back to print page 2. The very, very last chart you have is the tax impact. Bring that over. And we look at the tax impact. We see both companies are pretty flat. There's been a little bit of increase here at the end. Looks like the taxes does help explain some of this drop and rise. We might be able to get a little bit more picture out of this if we change our denominator and numerator. And that's starting to look a little bit more like Walmart's chart. We can see taxes, the tax impact seems to be part of the reason for this shape. It also seems to be the reason. So here we can say taxes is important. Now for a lot of your companies, taxes won't be an issue. And you can see changing the axis has a big impact on how volatile the chart looks. So more than likely taxes is an issue. Doesn't look like turnover is. Turnover is very, very flat for both companies. Margins is probably not as big as an issue as taxes, but it's definitely an issue. And what's the last thing we have? It's financial leverage. So let's go look at the financial leverage. Here's their combined financial leverage. And what do we notice here? Here we notice that's actually important for both of these companies. Looks like a big deal. You can notice Costco's financial leverage is up a bunch. Walmart's has been flat, but again, you can see that 2019, the impact that happened. So something unusual happened in 2019. But the bottom line is Costco is flat on margins and ATO, but tax impact and financial leverage are main reasons their ROE has surpassed Walmart. So just looking at the chart. So this is a tough part of this is really a tough part of this first paper. Most students struggle with this because you have to look at so many different parts. Let me see if I can shrink this down a little bit. Maybe it won't be too bad. It's hard to read no matter what we do, but you're seeing this. If you just look, and this is the reason we do ROE decomposition. If we just look at return on equity, we say, wow, Costco, you're doing a great job. But then we get to the charts on turnover and margin. We say, okay, Costco's strong on turnover but weak on margin, but neither line's going up. Asset turnover and margin are not explaining why this is going up. And that's the main reason we want this to go up. The main reason Costco's ROE is going up is because of this tax impact phenomenon that happened with the tax law change from Congress, and then they're much more financially levered. So the two things that management doesn't really, we don't want to reward management for. First, the tax impact, that's Congress. You thank Congress for that, not management. And financial leverage, yeah, higher financial leverage cause ROE to go up, but that's not a good reason for return on equity to go up. So from a Costco standpoint, we can't really say that management's doing a good job just because the ROE is going up, because of the most important positive drivers of ROE, the combination of those two, they're flat, they're not improving. So it's really the tax impact and financial leverage. Now for Walmart, it does look like the tax impact does seem tax impact is the most important. There's some other things going on with Walmart. It's a little tough to explain, but we definitely can't say Walmart. There is, we should probably add in here though, declining margins and recent declining ATO is not a good trend. So while ROE is coming down dramatically, some of this is because of the decline in margins, probably margins more than anything else. This big dip in 2019 seems to be almost all entirely described by the tax impact. So it's tough. You just got to do your best. What you want to actually do is, if you can get all these charts together, just like I did here. So return on equity, and have it explained by turnover, margins, taxes, and financial leverage. You know what you're trying to do is look at the shape of the chart and try to explain it by the shape of these charts. And you may have to change your axis, because if your axis is too wide, the lines just become straight lines. So change your axis on the charts. Try to get rid of all the white space that you can. And that's why I say on these, it's really good on these to get rid of the 90th and 10%, so you can just see your company a whole lot better. There you can really see that decline in margin and see how flat Costco is. All right, so do your best. This is a tough part of the paper. I still think liquidity is the hardest, but once you get through that net working capital requirement, I think return on equity tends to be the second hardest for most students. The rest of the paper tends to be fairly straightforward, but if you can let it sink in, let the fact that return on equity has 4 inputs, 2 of them are good, 1 of them's out of control of management, and 1 of them is bad, and you're trying to figure out the shape of this chart by looking at what's going on in these 4 charts. That's the bottom line. Definitely not easy, but definitely you can, if you sit and look at it and think about it, I think you can come up with a pretty good answer. This might be one you really want to call me and email me your paper, and we just talk through it, and I'll give you my perspective. And I'm not going to say whether yours is right or wrong. I'll definitely tell you if you're saying something that is definitely not correct, where maybe you're going backwards on some of the numbers. But some of this is very subjective, and your opinion, just looking at what the charts are telling you and trying to get an assessment of what that means for the overall firm's profitability. All right, so we've finished going through Walmart. We've finished going through the class notes, and here's the template. You just follow this along. What we just did was the return on equity and ROE. What we started the class with was asset turnover times margin. So those two are about 12% of the paper. You bring in that Excel table at the end of your paper. Look at your graphs, give some good titles. That's actually a big part of the grade. And then everything else, you just go in order and knock them out. We've been talking about this, working with your individual companies. The only thing we have left is relative value analysis. We're almost to the very end of this analysis. Let's see how far we can get on relative value analysis today. So relative value analysis it's used frequently when people are trying to pick stocks that they want to buy in their portfolio. So it's a screening mechanism. If you join the investment society, we have classes that we teach how to use the Bloomberg machines to actually build a screening model for stocks. That's a good thing to learn if you're not a finance major, but you want to learn how to do that. I've had engineering majors and other degree majors come in and actually walk through our process. I actually remember one engineering major. He joined the investment society the first semester he joined. He wanted to be a senior analyst and actually teach teach this to other students, even though he'd never seen it before. He watched our videos, taught himself how to do it. I was really impressed. The first time I showed up, I set up time to come show him how to do it. I show up and he's already built his model. He used our videos and he taught himself how to do the whole thing. And then his team, he put together a team. They went into our competition. We have a competition for these models. And his team actually was one of the top 3 teams, even though he was just starting, didn't have any background in this at all. So this is something we do have several videos that if you want to teach yourself, it's tough now with COVID and the financial lab is shut down, but there are Bloomberg machines over in the John Peace Library. You can watch our videos and teach yourself how to do this, but I'll walk you through the theory. So I want to start off with relating this to what we're doing in the rest of the class. What is relative value analysis versus what else we're doing? I'm then going to use real estate as an example. Most people just naturally use relative value analysis when they're looking at buying a house or we're looking at buying a piece of real estate. So that's pretty natural, and it's most people it just makes sense. It's a fairly logical way to think about purchasing something. But then we're going to talk about, let's make this specific to stocks. What does a good relative value analysis look like? What should be the components? Then we'll look at the common ways of doing it. And on your example for your company, I gave you 4 price relatives. You'll pick at least 2 of them to talk about, and we'll talk about which one you should pick depending on what industry you are in. So we'll do some industry linkages. If we have time, I'll show you some models. Probably not in today's class, but I'll show you some models that we've actually built so you can see how it works. And I think once you see them, you'll get pretty excited because it's not that difficult to set up. And once you build one yourself, it's pretty impressive in an interview to say you've built a model like this. So if you're interested in that, we can definitely get in that detail. So let's start off with common approaches to investing. You want to buy a stock. Which stock do you buy? So that's called security analysis. Or you want to figure out, do I invest in US stocks? Do I invest in European stocks? That's an asset strategy. So you're trying to figure out where do you want to invest. And there's 3 approaches that we use for trying to figure out where we want to invest our money. The first one is called fundamental analysis. We are doing fundamental analysis right now. What you did on paper 1, we're looking at liquidity, solvency, turnover, margin, return on equity. That is fundamental analysis. The other part of fundamental analysis we'll do later in the class, and that's called discounted cash flows. So fundamental analysis includes financial analysis, includes discounted cash flows. You put those together, you have fundamental analysis. When I started my career as a security analyst, I did fundamental analysis because that's the way I was taught. I did some relative value analysis. I did very little technical analysis, but I did a whole lot of fundamental analysis. Technical analysis we do not cover in this class at all. I do cover it in my my security analysis class, but I don't cover it in this class at all. But what technical analysis is, it's trying to use patterns in stock prices. And really what you're looking for is some type of imbalance between the supply and demand. And that imbalance between supply and demand causes a stock pattern that tells you whether you need buying or selling. The most common type are moving averages. If stocks are above their moving averages, usually stocks that are rising tend to keep rising for quite a while. Stocks that are declining tend to keep declining for quite a while. So that's technical analysis. We won't use any technical analysis in this class at all. And so where we are now is relative value analysis. Relative value analysis does not include financial analysis. Everything you did in project 1, except for obviously we end up with relative value analysis, but everything you do up until relative value analysis, that's fundamental analysis. So now we're shifting gears and going to relative value analysis, a very different type of analysis. Basically, bottom line, relative value analysis is taking some current measure of value of an asset or security. It could be its price, its market price, what you could buy it for, and you compare that to some underlying, there's that word fundamental again, some underlying fundamental factors. So what in the world does that mean? Well, current measures of value that we will use are price and enterprise value. Price is the value of the company to the stockholders. Enterprise value, anytime you see enterprise value, that is the value to the stockholders and the bondholders together. So price is just stockholders. Make sure you get this in your notes. Price is just stockholders. Enterprise value is both stockholders and bondholders. Now be careful. Enterprise value, that's EV. Later in the class, we're going to use EVA. The EVA later in the class is not enterprise value, it's economic value added. So don't get enterprise value mixed up with economic value added. They're two very, very different things, completely unrelated things. So enterprise value, and then later in class we'll do economic value added, EVA. So EV and EVA. So here we're doing enterprise value. It's the stockholders and the bondholders value. And then those fundamental values can be any measurement that the assets that we're assessing have relatively available. In our case, we'll use something related to earnings, revenue, and book value. Essentially, our fundamental factor is going to be some accounting number off the accounting financial statements. So just to give you an example, price to earnings, you've probably heard that before, the PE ratio, price to earnings. Price to earnings is a relative value measure. We have price as the measure of value, earnings as the fundamental factor, and that tells us a lot about the company. There are quite a few industry specific factors. What I gave you for your paper 1 is very generic material because I needed a model that worked for any company. But if you look at what the Investment Society does, we're much more precise. We try to find ratios that are very specific to the industry. Relative value analysis is not trying to figure out if an asset is expensive or inexpensive in and of itself. What it's trying to do is figure out if something's expensive or inexpensive relative to something else. So let's assume the overall stock market is fairly well priced, but the individual securities, some might be expensive, some might be cheap, but on average it's all about, the market's about right. So what we're trying to do, and I don't know why we use these words, I don't like these words at all, but we use the words cheap and rich. Cheap means it's inexpensive. I would rather have had inexpensive. If I was the one coming up with these terms, I would have used that term. But they say cheap. Cheap doesn't mean cheap as in, low quality. What cheap means is inexpensive. Rich just means it's an expensive stock. So we're trying to find assets that are cheap. That's right. That means they're inexpensive. They're a good buy. We're trying to avoid assets that are rich. That means they're overpriced. So let's look at real estate. And my guess is once you see this, you're going to go, oh, I knew that already. So yeah, I'm doing something you already know, but I'm putting a new term on top of it. I'm calling it relative value analysis. So let's say you want to buy a house in a particular neighborhood, and all you know is the price of the house is $150,000. You can't visit the house. You can't see it. You don't know what it looks like. Would you buy it based purely on price? And my guess is probably not, unless you're in just an incredibly wealthy neighborhood that even if it's on a tenth of an acre lot, you can get 150 maybe, but you don't know, maybe there's some contamination on that lot. Maybe they've had a mudslide, who knows? But the price is 150. That's not enough information. So then you get a little bit more information. The house is trading for $150,000. And 2 other houses in the same neighborhood, one sold for $875,000 and another one sold for $675,000. Would you buy it now? Well, it's tempting. It's more tempting, but there's obviously a big difference between this house that's $150,000 and those other 2 houses. There's something going on with that house. So there's no way it's as good as the other 2 houses, or it wouldn't be trading for so cheap. It might be a good buy, but you're a little nervous. So let's find some more information. Let's say we find out that this $150,000 house equates to $75 per square foot. And those other 2 houses that sold, they sold for $250 and $225 per square foot. Now do you buy it? Now it's getting much more interesting. And I can already tell you now, we've already done our first price relative. Price to square foot, or price per square foot, is a price relative. Now remember, when we were doing your project, we were doing revenue per square foot. That is not a price relative because we're not using price. There you're taking revenue and square foot. Those are both fundamental values. Those are both accounting factors. Here what we're doing is taking price, something that's not a fundamental factor, it's an actual value, a value of the property, price divided by square feet. So we're taking the price divided by fundamental factor square foot. That is a price relative. Now we feel pretty good, but we're still like, what's wrong with this house, right? That's the thing we're all thinking. You might buy this house unseen and just hope you can fix it up and get it to the quality of these other two houses, but right now you're not too sure. So you do one last analysis, you bring in all of these factors. The size of the house, which you've already done with square foot. Does it have a pool, number of bedrooms? How new is the quick kitchen? How high quality is it? How old are the floors? What about the roof? The fences, the garage, does it have two-car garage, one car? Is this in the same school district as the other ones, and is it a good school district? So you have some things related to fundamental values, not value as far as price, but value in terms of accounting values. And then you have some things related to risk. Is the house in the floodplain? So like I said, like in California, it's possible you're buying a house that's on a cliff that has a major mudslide, and there's a possibility that entire property just slides off the side of the cliff. Does it have serious foundation issues? There are certainly some places throughout central Texas where the ground isn't kept watered, and that causes the foundation to crack, and that can be a pretty expensive fix. How close are you to the fire department? I've watched some of these TV programs on annoying neighbors, and boy, there are some annoying neighbors. Most of these programs are in the UK, so, but I remember one in particular. This guy bought a house because it was really cheap. He knew there was an annoying neighbor, but he said, well, I can put up with that. And boy, he found out why the house was so cheap. Those neighbors were absolutely horrendous. So that's all related to risk, and this is key. When you're taking the price of something, you want to compare it to things related to accounting values, and you want to take it and relate it to things related to risk. You have to have all of these components in there. And let's say you bring all of these factors together, and here we tie back to your statistics class. You can get an R squared of 91%. You looked at 350 houses sold over the last 3 years, and you can, using your model with all of these factors, you can explain the sales, you can explain 91% of the variation in house prices using these factors. And based on that, this house that you can buy for $75 per square foot is actually should be trading for $150 per square foot. Well, now you're pretty excited. Now there's 9% missing. Maybe that 9% you can't explain with these factors. Maybe that's what's really impacting your house. You don't know. But it looks pretty good. You can buy a house for $75 that should be selling for $150 given all of the factors. You've included every factor, and maybe I've included every factor. Maybe there's 7 or 8 others, but just assume I included every single factor you could possibly care about or think of. And based on that, this house should be trading for $150 per square foot. You can buy it for $75. You still haven't seen the house, but you sure have a lot of information about the house. Well, let's see if we can get our R squared up to 98%. So we add 2 more risk factors. Has anyone ever been murdered in the house? And is the house considered haunted? So you bring those 2 factors in, and now you can explain 98%. And when you do that, the value of the house drops from $150 down to $80. It's still a good buy, but it's dropped. So that tells you one or both of these 2 things have happened. So now you've got something to think about. These factors are all important to you. These are very, very important factors to you. You don't care about these 2 factors. You don't care if someone's been murdered in the house. You don't believe in haunted houses. You don't care about that. So essentially, based on your model, this house is worth $150 per square foot, and you can buy it for $75. These 2 factors you don't care about definitely reduce the value of the house, but you don't care. So what do you do with that information? Well, if you plan to live in the house for a long period of time, then I would say buy the house. You're paying $75 per square foot for a house you think is worth $150 per square foot. That's a pretty good deal. If you're going to have to sell the house within the next 2 years, then you might care, because the next person who buys a house from you, they may care about these things and they may think the house is only worth 80. It's still an okay deal, 75 versus 80, but it's not going to be the big sale price that you're expecting, going from 75 to 150. So, and this is true when we talk about companies and stocks. You may have factors that you think are important, and when you do that, you find out that a stock is, you think it's worth $100 and you can buy it for $50. But then you bring in some factors, you get your R squared up to 98, and there's other factors that the stock market's really focused on that you don't think's that important. You think the market's focused on the wrong things. And instead of that stock thinking it's worth $100, now it's only worth $55, and you can buy it for $50. It's not much of a deal. Well, if you're going to hold on to the stock, if you're like a Warren Buffett type of investor, you're going to invest like an owner, and you're going to stick with it for the long term, then yeah, you think it's worth $100, you can buy it for 50. That's a great deal. If you're a day trader and you're trading back and forth real fast, the fact that there's factors that you don't care about that are important to the market, you're probably going to have to take those in consideration, because until the market figures out that it's right, it's wrong, and you're right, you're going to be having to put those factors into your model. So there's the real estate example. This is relative value analysis. When you buy a house, you just automatically do relative value analysis. You may not do it with R squareds and computer models, but at least mentally you're thinking about it. Oh, this house is trading for 150, and this other house is trading for 250, but this house that's cheaper has an old roof and has the fence is coming down. It doesn't have very nice trees and landscaping, doesn't have a pool. You know, you're doing it in your mind. It'd be better to do it statistically, but you're at least intuitively taking that in consideration. You're not looking at whether the entire housing market is overvalued or undervalued. You don't really care about that. You're trying to figure out if this house relative to other similar houses is cheap or rich versus those other houses. So the price relative needs to be appropriate to whatever industry you're looking for. You got to make sure you have those key fundamental factors. You have to have key risk factors. There are certain price relatives or key fundamental and risk factors that are really good, that work for all industries. But there's even better ratios that are very specific to the industry you're looking at, that your company is in. So all three must be right. You be present. The correct price relative. Do we use price or do we use enterprise value? Do we do price to earnings or whatever? So we need to have the right price relative. We have the right measures of fundamental value, whether it's generic or industry specific. That needs to be in place. And we need to have some measure of risk. Some people have the fundamental value, but they don't have the risk factor. And when they do that, they end up with a stock that looks really cheap, only to find out it's just a really risky company. So that wouldn't be good. You don't want to say, wow, this stock's really trading cheap, and you buy it because its price to earnings is really low, and then you discover they're loaded up on debt and they could go out of business at any time. That's kind of the Kroger's or Macy's example, where they look really cheap until you put their debt in, and then they look really expensive. So everything's got to be there. The right price relative, the right fundamental value, the right risk. You got to include all those. So the goal is to use those fundamental and risk factors as independent variables to try to figure out what should the relative value factor be. So looking at the firm's liquidity, solvency, turnover, and margin, you look at all that and you say, wow, this firm should have a price to earnings ratio of 23, and it's actually only 16, so this is a really cheap stock. But then you have to bring the risk factors in. How much debt do they have? Those kind of things. I think I mentioned solvency before, which is the risk factor. But you want to bring everything in. Everything we talked about with paper one are the types of things you would bring in to try to figure out if this firm should have a higher than average price to earnings or lower than average price to earnings, or whatever ratio we're going to use. I'm going to skip this part here. We might come back to it. It's pretty important. We haven't covered this yet, so I'm going to put this as a holding spot. I think for finance majors, this is really, really important. I cover this in more detail in my investment class. It's possible. This is one of those things, if we have time, after we do the valuation of stocks later in the class, I might come back to this, but we may not have time. If you are a finance major, though, I do recommend that you print this out, and maybe during the summer break, maybe give me a call and I'll walk you through what this means, because I think for finance majors, this is actually quite important. And after we do the valuation of a stock, which is what this formula is, after we do this valuation, then this PE ratio makes a lot of sense. But for right now, don't worry about it. Just know that it's there. So here are some companies using price to earnings ratio. That's a price relative. Zoom is trading, the last time I put this up, I haven't looked in a while, but Zoom is trading for $263. So you have to pay $263 for $1 of earnings. That's an expensive stock. Ford, you only have to pay $8 to get $1 of earnings for Ford. Walmart is at 21. Amazon's 94. Now Amazon used to be 200 and something, just like Zoom, and their PE didn't come down because their price came down. Their PE came down because their earnings soared. So it was a good stock to buy. So what is this telling us? So Ford's at 8 times. Does that mean Ford's really cheap? That means it's a good stock buy? Or it could be a fundamental thing. It could be that Ford's just growing really slowly. Slow growth, firms with slow growth have low PE ratios. It could be that they're high risk. Firms with high risk have low PE ratios, or some combination. They could be cheap, but they could also be slow growth and high risk. When you adjust for all of these, maybe their PE ratio should be 10, but it's only 8, so you can buy it at 8, and then you hope it goes up to 10 and you make a lot of money. What about Amazon? Amazon could just be an expensive stock at 94. The stock market itself is around 23, 24, about where Walmart is. Walmart's pretty close to the typical stock. So you can see Amazon's much more expensive and Ford's much cheaper. So is Amazon rich? Is it a stock you should avoid because it's overpriced? Is Amazon trading at 94 because it's a high growth company? And that's probably true. Is Amazon trading rich because it's a low risk company? Low risk companies have high PE ratios, or some combination. Now Walmart is probably not a high growth company, but they are a low risk company. So they're slow growth but low risk, and that's why their PE ratio is much higher than Ford's. Ford is definitely not a low risk company. They're definitely a high risk company. They have very high, very high debt. In fact, almost the highest in the entire market. All right, so we have numerators like price, enterprise value. Those are your two choices on the numerators. Then you have denominators. They can be earnings related. So you can price to earnings, which is the same thing as price to earnings per share. Price to EBIT. No, I'm sorry, not price to EBIT. Enterprise value to EBIT. I'll explain why. Enterprise value to EBITDA. Or price to book. Or enterprise value to revenue. I'll explain why I'm picking those. So the key is whatever's in your numerator, whether it's stockholders only or both stockholders and bondholders, you need to make sure whatever's in the numerator is consistent with what's in the denominator. So remember, the numerator can be price. If it's price, that's only stockholders. If it's enterprise value, that's stockholders and bondholders. So if you're only stockholders, you want to make sure what's in the denominator is after interest expense. So if the denominator is before interest expense, so earnings before interest and taxes, earnings before interest, taxes, depreciation, amortization. Revenues before interest expense. Think about your income statement. Revenues at the top, interest expenses at the bottom. All three of these numbers are before interest expense. Because since it's before interest expense, it belongs to both the stock and the bondholders. You haven't paid your bondholders yet when you have before interest, and revenue. So EBIT, EBITDA, and revenue, it should always be enterprise value to those. If the denominator is after interest expense, so earnings per share, that's net of interest expense. Book value, that's the net book value, the net worth of the firm. That's after all the interest expense. Then you use price. So that's why I said up here, you have price to earnings, price to book value. You have enterprise value to EBIT, enterprise value to EBITDA, enterprise value to revenue. All right, you might want to write that out again. Let me say it again. These are the choices. And the ones I give you for the paper for Project 1, I only give you the correct ones. So price to earnings, because earnings is after interest expense. price to book value, because book value is net of interest expense. Those are two choices. Or enterprise value to EBIT, enterprise value to EBITDA, and enterprise value to revenue. So there's 5 combinations. 2 of them are price to earnings, price to book value. 3 of them use enterprise value. Now, if you go to Yahoo Finance and look up a company, you'll discover they do all of these that I just showed you, and they have one extra one. They actually have price to revenue. That is a bad ratio. Yahoo Finance should not have that ratio, but some people do use price to revenue, but that's wrong. That's an incorrect ratio. If you use price to revenue and try to screen for which stocks you want to buy, you're going to end up with a bunch of stocks with a lot of debt, and that's not what you want to do. You've got to make sure if the firm has a lot of debt, they may look cheap if you use price, but if you add back all that debt to the price that gets you enterprise value, now it doesn't look so cheap. Now it looks expensive. All right, so price to earnings, EV to EBIT, EV to EBITDA. There's something called the PEG ratio. We're going to ignore that, but if you're a finance major, I would encourage you, or if you're interested in stocks at all, go do a search on PEG ratio. It's a really interesting ratio. There's people who love the PEG ratio. If you're buying tech stocks, PEG ratio is actually pretty important for stock investors. And in the Investment Society, we do something similar to the PEG ratio, but we actually have a ratio we think works even better than the PEG ratio. So you can adjust that a little bit. Price to book, or you might have a firm that has really volatile earnings and their book value. A lot of firms have been buying a lot of their stock back, as we talked about with Paper One, the Project One, where we talked about where's all this cash flow going. Are they buying their stock back? And there's firms that have bought so much stock back that their book value has gone negative. So price to book value doesn't work. So what you can do is just do price to many years of earnings. So here's something else you can research if you're a finance major or really interested in investing. Look up the term Robert Shiller, S-H-I-L-L-E-R. If you type Robert Shiller data, a model will come up. It's called the CAPE ratio. You can get it for free. It's on the internet. It comes up in an Excel model. And this is what Robert Shiller does. He's a Nobel Prize winner in economics. He takes the price of the market of the S&P 500 and compares it to inflation-adjusted 10 years of earnings. And based on the analysis, he's trying to figure out the stock market's overpriced or cheap, rich or cheap. And right now, he says, based on his analysis using price to multi-years earnings, he says the stock market's the 3rd most expensive it's ever been in history. The most expensive was the late 20s, before you had the Great Depression and the stock market crash. The 2nd most expensive was in 1999, right before the dot-com crash. And now we're at the 3rd most expensive period. But interest rates are really low, so there's a lot of analysis you can do to see if stocks are expensive. But I would encourage, if you're a finance major, if you can't find it, call me and I'll walk you through it and show you how to use that. But it's free and it's an interesting analysis. This analysis actually shows that both stocks and bonds are ridiculously expensive right now, which means there's just not much more. Maybe you should go back to what we started with, which was real estate. And then you have revenue-based, EV to sales. Now the question is, which of these should you use for your company? So here's earnings-based relatives. So these earnings-based ratios, price to earnings, EV to EBITDA, EV to EBITDA is probably the most popular right now, although PEG ratio is pretty unpopular. Those tend to be used with technology companies. I will say price to earnings is used for all industries, but specifically technology companies where you're really focused on revenue and earnings growth, price to earnings, and especially EV to EBITDA is really popular right now. And some people think it's just because people like saying EV to EBITDA. It just sounds fancy. I think partly it's because it gives you the lowest numbers. So if you're trying to convince your boss to buy a stock, EV to EBITDA might be 6, where price to earnings might be 18. They're the same number because you're adding all this stuff back to earnings. But it's better to tell your boss, hey, they're trading at a relative of 6 versus a relative of 18, even though they're the same number, they're adjusted, they're the same thing. It just sounds better to say 6 instead of 18. Your boss is more likely to do the trade. Book value relatives, price to book, it's really good for firms that have a lot of capital requirements. Utilities, manufacturing, if they've got a lot of property, plant, and equipment, price to book is the best ratio. It's really good for cyclical companies like energy and materials, so oil companies, steel companies. Price to book makes a lot of sense because commodity prices are pretty volatile. And if you use price to earnings, a stock might look cheap just because oil prices are at their peak. Our stock might look expensive because oil prices are at their bottom. So if you use price to book, you spread that out to multiple years. And then my industry, which is banking and insurance, they use price to book because they're really focused on return on invested capital. We haven't talked about return on invested capital. We will talk about it some when we get to economic value added. So for these type of industries, utilities, manufacturing, energy, material companies, banks, insurance companies, real estate companies, firms that buy and sell real estate, price to book is the best relative. And then revenue based is for those industries we talk about where margin's so important. Retail, so grocery stores, Wal-Mart, travel, just anything that's really focused on retail and where margins are really key, especially firms. Travel might not be so much, but retail where they have a cost of goods sold, so restaurants, those kind of things. Earning enterprise value to revenue is the best measure. So what can we do with price relatives? We can screen for stocks. I'll try at the beginning of next video give you some examples of some models that we built. And then if you're really interested in it, boy, join the Investment Society. It's kind of too late for me to tell you in this video because the Investment Society has been going for a few weeks, but I'll emphasize it in the class before the Investment Society meetings. We have a class where we're teaching students how to do exactly this. So if you want to learn that, even though you may not have access to a Bloomberg terminal, you can watch, and then when you have time to get to the terminal, you have the videos that we've created and you can create your own model. So it's really good to do a screening model. If you're going to interview with an investment firm as a finance major, definitely you want to have done something like this. And you definitely want to have a stock portfolio. Now maybe you don't have a lot of money to buy stocks, but you can easily go to Ameritrade or to thinkorswim.com, these online brokerages, and most of them will have a paper portfolio option where you can set up a stock portfolio and just use paper money, just play money. I really recommend if you're going to interview with, and I've had several investment firms call me asking for candidates for jobs. Here in town, Victory Capital has, and I've had others. In fact, several here in town actually. There's a few firms that have been asking for UTSA students. You don't want to go interview for a job, and those type of firms have never done something like this. You don't have your own account. So talk to me if you're not sure about that. Talk to me and I'll help you get it set up. You can use it to value non-publicly traded companies. So USAA sold its investment firm, its investment company, to Victory Capital. How did it figure out how to value that? How much to sell it for? They probably use a ratio like we're doing. They probably use enterprise value to assets under management, which is like one of those industry-specific ones. If USA were to sell its bank, it would definitely use price to book value to try to figure out how much they could get for their bank. You can use it to determine benchmarks for your company. So you say, okay, our company is trading at 10 times earnings, but our competitors are at 16 times earnings. What is it? What's going on? And you go, oh, our margins. Man, our margins aren't doing very well. So you can use that to help set where do we need to focus our company. And that gets to that last bullet is it helps you understand what is the stock market most closely focused on right now more than anything else. And especially if you can bring in more industry specific factors that can really help you really pinpoint what's going on with the company. So for example, industry specific, a good example is the airlines industry. They have something called available seat miles. You can't use that with Kroger's or Wal-Mart or Exxon. Available seat miles is a specific ratio to the airlines industry. Utilities have something called regulatory assets. They like to use price to regulatory assets or enterprise value to regulatory assets. A regulatory asset is an asset that the regulators allow them to put into their rate base. So that's important to them. Sometimes with energy companies, you might do enterprise value to proven reserves. So it just depends. Everyone's a little bit different. Every industry has their unique thing. So I'm giving you these generic ones, these generic ratios. They can work for all industries, but the more specific you can get to the industry, the better your model will be and better it will tell you. So I'll start next class giving you an example of this and just whet your appetite. That in some of you, I'd get real excited if you're not a finance major, but you still want to do this. I still have to say that engineer major who just joined the society for 1 year, he wanted to learn this, he competed. I mean, that's guts to step in and do that. I don't know if I could have done that and joined some student organization in the engineering School of Engineering. I don't think I would have been able to do that. So that's really impressive. So if you're a marketing major and you want to learn this stuff, yeah, go for it. It would look really impressive on your resume.